Thanks so much for tuning in to Saal Mubarak, and to you and yours, a very happy Diwali and a prosperous new year. And this year, yet again, we have someone that we love talking to and getting his views, and more so on such an auspicious occasion, Ridham Desai. Ridham, thank you so much for making it 3 years in a row. It's lovely having you.
Thank you, Neeraj, for having me on the show. A very, very happy Diwali to all your viewers, and of course, Saal Mubarak. And hopefully we get another prosperous year like we have got the one that's going by.
Yeah, forget the quantum of the prosperity rhythm, but there is a lot of fear around whether it will be a prosperous year or no in the first place. What's your sense about the new Samvat as we stand right now?
See, I think, Neeraj, this year-to-year forecasting that I've been doing for the past 30 years is really misleading. When you look at the equity asset class, it's a long-term asset class. It's a really long-duration asset class. Those who have been faithfully invested for decades know the fruits of that investment. And those who try to play this thing on a tactical basis, trying to time tops and bottoms, really don't come away as successful. Of course, it's my professional hazard, which is that I have to still try and time the tops and bottoms. But for most people who are on this show, watching us, the best strategy is just stay there. The Nifty or the Sensex has compounded something like 17 or 16% over the last 37 years since I first traded in a stock way back in 1985. And through these 37 years, we've had some massive corrections. We had a blow up in 85. We had like a 60% or 70% decline in 1992. We had a similar decline in 2000. Another decline of similar magnitude in 2008. A smaller one, but albeit a still sharp one in 2013. And then in March 2020, when stocks nearly halved. Imagine, like we get 60-70% corrections once every 5-7 years. Stocks get completely crushed, and yet we come away with a compounded return of 16%. It's possible that the next 2 or 3 decades we don't get 16, maybe we get 12 or 13, and we will get a lot of these corrections along the way. But the ones who stay put are the ones who will come away wealthy. So it's a long-winded answer to your question, which I've really not answered, but we will probably answer that through the course of this program.
Yeah, no, but this answer reminds me, I think, of a note that you wrote, Ridham, that if people missed out on some of the best days by not staying invested, then the returns would have been really, really pedestrian, if I'm not wrong.
Yes, absolutely. And nothing in the system guarantees that you will not miss the best days, even if you avoid the worst. So people try to avoid the bad days, but in the bargain also miss some of the best days. And they're very hard to call, actually. I think the best traders and best investors struggle to make these calls. And nevertheless, the market is, has been a bit overheated, especially on a relative basis going into October. And, some correction is due, at least on a relative basis. The absolute index levels are hinged to what the world does at large. And, Neeraj, it is important to remind people that India is now the 5th largest stock market in the world, $3.4 trillion of market cap. There are only 4 markets now that are larger than us. UK is just marginally ahead of us, and in a 3% day, we'll overtake UK. And then you have Japan, China, and the US. So that's how big India has become. It cannot do its own jig. It's not a small cap stock that can do its own thing. It will be tethered to what the world is doing at large. And so far as we have this bid on US stocks, it's unlikely that India gives a major absolute correction. The contrary also is true. But the relative performance has been quite staggering. We've done 30 percentage points outperformance in the last 6 months. And if my memory serves me right, I think you have to go all the way back to 2007 for that type of outperformance. So on a relative basis, maybe a little bit of a cool-off, which is what we are calling for. Also, the gap between small and large cap stocks needs to narrow. So small cap stocks have run away And we're already seeing that correction as we speak through the month of October. And maybe large caps play catch up, so small caps underperform large caps. And one final point on this tactical thing is that individual stocks are doing their 20-25% correction anyway. The reason why the index is not reflecting that is because these stocks are not all correcting together. They're doing it, on different time zones or different time frames. And since I strongly believe this is a stock pickers market, those who are in this whole tactical business really want to focus on the stocks rather than the Nifty or the Sensex and wait for the whole market to come down and try and time it that way. I think if you do it at an individual stock level, then you've already got quite a few stocks that have done healthy corrections from their recent highs.
Actually, maybe I should have started off with talking about the Samvat gone by, but we'll talk about the key learnings towards the end of the show, since we are already into this conversation about what we are, where we are right now versus where we could go to. Ridham, what do you reckon is your biggest worry? Is it on the global side? Is it the inflationary pressures or inflationary markers that have started to come at the fore, or is it something else?
So Neeraj, before we get into that, let me talk about what makes me actually very bullish on a structural basis. And what makes me bullish, I think, is this unprecedented support that we're getting from policy for risk takers. Actually, that started in the fall of 2019, in September 19, when the government cut corporate taxes surprisingly and in quite a large quantum. And since then, for the past 2 years, we've seen recurring moves from the government to support risk takers, to support entrepreneurs. And when you have a policy environment that is supportive of entrepreneurs, you can't but just be invested in equities, because equities is how entrepreneurs express their business. So it is a sweet environment to own equities. I don't think this policy support is going away in a hurry, because it is the only way India can get back its growth mojo, in the sense that you get corporate profits going, and corporates make more money, they will invest them, and then when they invest that money, you create demand for jobs, you create wages, you create consumption, and you get a whole virtuous cycle. This has been missing since 2006, when Manrega was enacted, and we tried to engineer a transfer from corporate profits to the labor sector. And that's not really something that works for India, because India has excess labor. So you create inflation. Then you lift real rates to bring down inflation, and you get growth down. And that's how we have lost the past decade and a half, I dare say, in that policy experiment. Now we are back to where we ought to be, which is try and boost the corporate sector. So this is, and we get multiple signals along the way. The photograph that the Prime Minister had with Rakesh Jhunjhunwala, the overnight reversal of the decision of the Railway Ministry. A lot of these things are unprecedented in Indian history. We have not seen such a proactive government that is, favoring risk takers or entrepreneurs in this fashion. So that makes me bullish on stocks. So that's where we are. It's a new growth cycle, and I don't think stocks are fully priced for that. The worries are. Yeah. Sorry,
can I ask you a cross question though on that point, and then we'll get to the worries.
Yeah.
Sorry, but just wondering, from a global central bank to an Indian central bank perspective as well, Ridham, thus far inflation has been a Goldilocks scenario. We're now starting to see that worsen a bit. You don't reckon that global central banks, or policymakers which have hitherto been favoring all that risk takers would want to lean against the inflationary pressures, and thereby that could cause some damage to equity sentiment? No?
Neeraj, I hope that the Fed starts worrying about inflation sooner than later. Because what will kill the global bull market is unexpected inflation and the Fed falling behind the curve. If the Fed keeps its nose slightly ahead of the curve, markets will welcome that. They will not worry about it. Of course, you will get volatility in that moment when the Fed changes policy, but a well-guided Fed situation is not bad for the market. The relevant example is 2004 to 2007. There were multiple rate hikes. It didn't prevent the equity market from going higher. We got a few corrections along the way, especially in 2004 when there was an inflection point in Fed policy. and stocks, especially in the emerging world, fell by almost 25%, including India. But it did not kill the bull market because the Fed kept its nose a tad ahead. It's when the Fed falls behind the curve, that's when I think we start to worry, because that's when earnings will get affected, and that's when the P multiples fall. So per se, raising rates is not the issue at all. It's about anticipating inflation and being ahead of it. There will be volatility, of course, around it when the Fed finally says we are coming off zero rates. And that volatility will be a good moment for people to re-engage in stocks.
Interesting. Okay, now to the worries, Ridham. So if inflation is not really that big a worry, presuming
no, inflation is a worry because we have not really tackled it. So I'm hoping that the Fed, the framework here is that the Fed raising rates is simply not a bad news. It's about whether they can anticipate inflation or not and stay a little ahead of it. If they fall behind the inflation situation, then I think we have a problem globally. Of course, we also have a problem with the commodity complex, especially energy prices. Now, ordinarily, the energy prices only hurt when they are caused by supply constraints rather than by demand. There's a combination out there, supply, demand, both are at play. The way I look at it is that you plot the relative price of oil to copper. If that's rising, then it's largely supply driven, and that's a problem for India. It's not expressing itself in any macro concerns right now because India has a very healthy balance of payment situation. And to that extent, energy is being absorbed. But it does cost companies in terms of earnings. And we're seeing that in this quarter. Margins will go down in some sectors. So it does lend itself to some sectoral reallocation if it continues. And of course, then a threshold comes when if energy prices rise too quickly, then it's a problem for India and stocks could correct. So that's the second thing. The third thing I think which we should worry about is India's own political cycle. There are a bunch of elections coming up next year because at the outset, as I explained, a lot of this hinges on supportive government policy. And if something goes wrong on the political front, which then prompts the government to rethink what it is trying to attempt, then it could, cause a more prolonged problem for stocks. In fact, it could even reverse the bull market if policy fluctuates away from the current situation. So those are my three concerns, along with the Fed, as you already highlighted. And then there are a few other things, but they are not really significant. Like, we'll keep checking the quality of IPOs that are coming to the market. I think it's still early days. We're still very early in the primary issuance cycle. But at some point in time, the quality of IPOs will start suffering. That is usually a good signal that stocks are getting overdone. But it's still early, and it may not be the concern for 2022, maybe 23 or 24 further down the time.
Unpredictable, but global geopolitics or the murmurs of the local standoff between India and its neighbor, does that worry you at all? Or do you think that's too much noise and not something that we can do much about?
So largely, I would classify that as noise. There's nothing over there that's going to impact growth and earnings. If anything, actually, the current global geopolitical situation favors India. We call it the multipolar world. So the world was largely bipolar, i.e. China was concentrating all the production, America was kind of with all the consumption. Now the consumer markets are getting more diversified, China is getting bigger, India is getting bigger. And production at the margin is moving out of China. And India has very aptly launched all these production-linked incentive schemes, reversed the retrospective tax, cut corporate tax rates. And I think all these policies are geared towards boosting India's FDI, which is likely to go up significantly in the coming 5 years, as a lot of corporations around the world rethink their China strategy and look at India as an alternative destination for creating supply chains. So I would imagine that the global geopolitical situation actually favors India. with its own neighbors, actually, things are quieter today than they have been in the recent past. But those really don't affect India's growth directly and therefore really do not have much bearing on stocks. So I'm not paying much attention to that right now.
Okay. Ridham, one more slightly broad question, and I love reading some of your reports at times when I get them, which is where in the valuation cycle are we? How many standard deviations above, below, relative to some of the other markets, and where therefore we ideally should be? So based on where, I mean, whatever the last note that you wrote, where are we, where we should be? Where should we be?
So Neeraj, see, the problem with valuations is as follows. We typically measure market valuations on two metrics, price to earnings and price to book. Okay. Now, the problem is that earnings are so depressed versus a normal environment that the price to earnings can be quite misleading. And again, I will take the 04-07 cycle as a comparison. In that cycle, earnings were compounding at 25% for the Nifty and price to earnings were rising. So both the lines were like this. Okay. And that is when you reached the peak in 2008 when the market was trading at over 30 times earnings. The preceding 4 years, earnings had compounded at over 25%. So imagine, margins were at peak levels, corporate profit share in GDP was 7%, and the PE multiple was at peak level. Now contrast that with the situation today. The absolute PE has not reached 30, but it's in the 20s. But the margins for the corporate sector are very depressed. Corporate profit to GDP is down to 2%. Now, just for argument purposes, if you normalize that and made it 7%, that would actually triple earnings from where we are. And if you did that overnight, then it will take your PE multiple down to a third. So is the market really that rich if it's trading at 20 odd times earnings when the earnings are so depressed? The only argument that you can give against mine is that, okay, the earnings potential is not going to be comparable with that previous period and we'll never go back to 7%. And okay, for a moment, I'll accept it, but I think we can still go back to 3.5, 4 in a normal cycle. And given all the policy boosts, I think that's a reasonable expectation. It will still halve the PE multiple, which means that we are not really trading at peak multiples. So this is the picture for somebody who's looking at a 3 to 5 year scenario. I am not actually worried so much about valuations. However, if you look at it on a shorter duration and say take a 6-month view and then compare India with the emerging world, just because India has outperformed as significantly as it has done, it is looking a bit rich. And therefore, our call that maybe on a relative basis, India needs to cool off a bit. And within the market, large caps need to play catch up with small caps. By the way, small cap valuations are now comparable to the peak of 2006-07. And of course, earnings are depressed for small caps, but on a relative basis, even large cap earnings are depressed, not as much as small cap. And therefore, there is a relative trade there. Maybe the Nifty outperforms the small cap index in the next 6 months. And maybe India cools off a bit relative to the emerging world. Maybe China makes a bit of a comeback because China's regulatory restraints seem to be now ebbing at the margin. And maybe China does a little bit of stimulus because growth has slowed down considerably over the past 12 months. And therefore, the relative trade shifts away from India to China. That doesn't mean the market goes down on an absolute basis. That still hinges on what the world does at large. But on a relative basis, it may feel a bit of pressure. So I hope that answers your question.
It does. It does. Thank you. And therefore, in that construct then, Ridham, and not necessarily this somewhat to the next somewhat where we hopefully talk again, but let's say a slightly longer view, what do you reckon that the playbook changes a bit in that the last decade services head and shoulders above manufacturing? Do you think the advent of manufacturing trying to actually taking leadership starts from here, from this somewhat onwards?
Yeah, actually, I think there's a very good case for manufacturing. You think about all the themes that are evolving in India today. So India is going through a major energy transition away from hydrocarbons to hydrogen, to gas, to solar. You think about the infrastructure investments that the government is trying to undertake. Then you think about how depressed capital stock is in India, which is the amount of assets that corporate India has. adjusted for depreciation. Since they have not invested over the last 10 years, most of the assets in the corporate world are running at the tail end of their life. So when you add all these things up, there's a major capex cycle on the anvil, which will favor the manufacturing sector. And therefore, we think that the manufacturing sector may gain share in GDP after having lost share for the last 20 years on the trot. And services gain share. So there is a little bit of a relative thing here in favor of manufacturing. Nothing to take away from services on an absolute basis, but on a relative basis, I think manufacturing outperforms services.
And in some of the most obvious themes, maybe getting priced in on the manufacturing side, the PLI beneficiaries or some of the others Ridham. So just trying to understand, you saying that in the near term, large caps over mid caps, small caps, manufacturing, not on an absolute basis, but relative basis might inch some share. But some of these are very well priced in as well, and you may not want to fish in those waters. So what within this whole wide bucket of manufacturing do you think takes center stage?
See, if manufacturing does well, and in fact, irrespective of what does well, whether services or manufacturing do well, financial services will benefit either way. So the safe way is to buy financial services. And when I say financial services, it includes a whole gamut of businesses that engage themselves in that sector, which is the banks, the non-banks, the insurance firms, the asset managers, the brokers, the card companies. There are a host of them. So of course, depending on where they are in terms of their business model, there is a fair bit of disruption happening there via fintech. So you have to be careful about individual businesses. They need to be prepared to take on the fintech challenge. And if they are, then I think that could be a sector that will benefit from this surge in manufacturing share of GDP. So that's one. The second one, I think, is consumption. See, because as I explained at the beginning, when you drive a virtuous cycle of higher profits, ultimately you create more jobs and you create more wages and you create more consumption. So instead of betting on the underlying trade, you go on and bet on the sector above it, which is a natural beneficiary of a higher growth environment. So consumption is a good place to be. Now, of course, some consumer stocks are trading at fancy multiples. So again, you need to check on where the valuations are. But then there are others that look quite attractive. And in the consumer sector, I think you need to adjust valuations for the return on capital that they have and the secular growth story that they are sitting on. Versus say cyclicals where the growth can go up and down and return on capital tends to be a lot more. So these would be my primary two sectors to actually capture the opportunity set that is coming. There is an opportunity in industrials as well, which comes out of a big capex cycle, which also I think will be of interest. But as you can see, I'm focused on domestic sectors, and I'm focused on sectors that are more geared towards economic growth than buying defensive sectors or buying outside or outward-facing sectors.
So is technology a relative no-no? Relative?
Yeah, so I've been wrong on this, Neeraj. Also.
I was about to tell you, you are right on this so many times.
Yeah, but I've also been wrong over the last few months. So the tech sector has surprised me on the upside. There were big gainers from COVID, which I didn't anticipate. And the businesses look very solid out there. In fact, if anything, outsourcing to India is only increasing. I think the experience that a lot of multinationals had with India during COVID was that India did not falter. I heard this comment from someone that you didn't lose your internet for any measurable time or electricity. And that's all that matters if I'm outsourcing to India. People were able to easily work from home without any disruption. So the confidence in India's ability to deliver services has actually gone up as a consequence of COVID rather than down. And it's one of the positive things that has happened. So I reckon that India will experience more business coming its way. Also, tech companies, I think, have surprised us in the way they have adjusted to the cloud environment for enterprises. Because remember, 10 years ago, they had zero cloud revenues and everything was enterprise, and we were worried about the cloud disruption. But they have adjusted the deceleration in enterprise growth versus the acceleration in cloud growth quite nicely. So I think on an absolute basis, they will still deliver robust growth. But as you said, on a relative basis, I think the opportunity in domestic sectors may be a bit bigger. Now, I've said this a few times over the last few months, and it's not playing out in the stock market in that fashion. And therefore, you have to take this with a pinch of salt. But hopefully, it comes my way in this summer.
Okay. Just a quick follow-up there. Does the valuation uptick, forget the business uptick, the business is looking strong and they are all saying that automation and the great resignation theme actually works for them. But does the valuation uptick surprise you? And do you reckon that there could be a multiple derating, multiple derating, if not an earnings degrowth, so to say, in tech?
See, in part, this is applicable to the whole market.
Okay.
The market has bid up stocks in anticipation of an earnings cycle. It's not, the market is not stupid, right? I mean, it's not like I'm the smartest guy on the planet and I see this coming. Everybody sees this coming, right? Everybody is seeing an earnings cycle coming. We don't know precisely how big it will be, and therefore that's not going to be always precisely priced in. But some amount of it is in the price, whether it is tech, whether it is financials, whether it's consumer stocks. Now, it all depends on how much growth actually eventually comes, and that will determine whether there is a substantial derating or a minor derating. But if you take a 3-year view, it is quite possible that multiples across the board are lower than what they are today, because growth would have caught up with share prices. And to that extent, I do think that stock market returns need to moderate over the next 12 months, or are likely to moderate over the next 12 months. The previous 12 months is no template for what we are likely to see. I think stocks will basically earnings will play catch up with stocks, and to that extent, you will get very strong performance, but not necessarily a similar type of stock price reactions as we may have seen over the past 12 months. In fact, we can see that in the current earnings season, even for companies that have surprised on the upside in terms of earnings, the stock price reactions have been less exuberant than earlier, which tells you that some of that was already baked into the share price. And I think you'll see more of that in the next 4 quarters.
Okay. No, sorry, I actually meant to ask this question from a tech company perspective strictly, but I'm glad I got this answer from you. One last question, or last couple of questions, if you will. One is on commodities. You briefly spoke about energy, but if there is one highlight for the last 12 months from a market's perspective, it's been the growth in this whole commodity universe and the stock prices thereof too. Is it a super cycle? Is it possible to talk about that, predict that? Or would you kind of now worry about the valuations? Steel, aluminum, what have you?
So, Neeraj, I wouldn't be inclined to call it a super cycle, but there are a fair bit of disruptions that are taking place. A good example is what happened to gas prices, natural gas prices. It all started with the clampdown on coal production in China, which caused electricity prices to rise, which caused aluminum prices to go up, and which caused gas prices to go up in Europe. So the interconnectedness of the markets is very different today than it was probably 15, 20 years ago. And very quickly, markets are adjusting to these things. Now, there is a whole climate change disruption that is out there, which is affecting the supply and demand of hydrocarbons. And that is, causing movements in other places. For example, copper. Copper is a big ingredient in the climate-friendly solutions that the world has, whether it is in storage batteries or other places. So because of these disruptions, I think it's a little harder to call commodities today, simply on the basis of where global growth cycles are and where supply of these commodities are. So I think it's a bit more complicated. My inclination is to back more simple stories like financials and consumer companies in India, then try and predict how these complex supply chains will evolve over the next 2-3 years in the commodity space.
Okay, I have one final question, Ridham, and that is from a earnings growth perspective. Where do you see the highest possibilities within the new age or the new themes, if you will, if I can call them that. The whole, I mean, something on a relative basis as small as the ethanol foray, or the electric vehicles, or green hydrogen, or real estate for that matter, which has always been there, but suddenly everybody talks about a new cycle out there. Where do you see the highest earnings possibilities relative to where they are right now?
You mean earnings growth for which sector will be the highest?
Relative to where it is right now, but from themes which have now just suddenly come to everybody's notice, so to say. I mean, maybe BFSI in absolute terms won't be great, but related to where the sector is right now, where do you see the highest earnings growth possibility?
Okay. So comparable to what we have seen in the trailing, say, 10 years. I think
5 years, what have you?
Yeah. So I think residential real estate is one candidate to have very strong earnings recovery. There's a big pent-up demand in resi real estate. Affordability is at all-time high levels. So I think we should see a very significant bounce back there in demand. Then I think earnings are very depressed in industrials because there has been no capex for the last 10-12 years. So there should be a very big bounce there as well. Earnings are very depressed in autos, especially in passenger vehicles and in the truck makers. So I think we should see a pretty big bounce there. So let's put these three on the table. Autos, auto ancillaries, real estate, residential real estate, and industries.
The last time before we sign off, Ridham Desai told me about a book which was, and I don't remember the name or the title, but you had said that it is a book which makes you think about the final few years of the life as you approach death. Please forgive me, I don't remember the title.
It's Preparing for Death by Arun Shourie.
Yeah. Sorry?
No, it came out last October, I think.
Yeah. So you had told me about it then, or told our viewers about it then. This time around, a book that you would really recommend before we sign off.
I just finished reading a book. It took me 6 months to read it. It's a very heavy one. Every page requires to be read like a couple of times before you understand what the author is trying to say. It was actually written 13 years ago. I just laid my hands on it. It's called The Beginning of Infinity by David Deutsch. He's a physicist, so he's an expert on physics. It's a very insightful book, but it's away from the theme of stock markets. I'm really enthralled reading it. There are a few things I disagree with David in the book, but that's fine. I think that's what the book is all about. You can disagree or agree, but he has some really insightful things to tell us about the world.
Much well taken. Thank you for this recommendation. I'm sure some people will benefit out of it. But Ridham, thank you for doing the show yet again. Really great having you as always. And to you and family, Happy Diwali and Saal Mubarak.
Thank you, and same to you, Neeraj, and to your family and to all your viewers.
Thank you. And viewers, thanks for tuning in.